Okay,
My YouTube channel is Affluence 8, Affluence 8 with no space.
got it. Affluence.
And I have a bunch of videos. Some of them, most of them, are about stocks. And I talk to clients and we talk to traders about positions. Mostly I'm mentoring. Mostly.
Okay, great, good.
Okay, so I'm happy you got a lot on the first section. This is section 2. Welcome to Retire into the Stock Market with Ivan. Welcome, Ivan. Thank you. How are you?
I'm doing great, thank you.
You're my last session for 2021. So tomorrow it'll be 2022, and we'll have the new year, God willing. And okay, so the first session we talked about trading versus investing. We talked about the cover call with Tesla. Talked about monthly income. Was that stuff meaningful to you?
Yeah, it's very helpful. Thank you.
Okay. What I didn't tell you is that I had to comb through 3,000 stocks to get Tesla.
Wow.
Okay, I had to comb through 3,000 stocks to get White Horse Financial dividend. So here's the thing: not all stocks can be cover call stocks. Just because I have an option doesn't mean you can write the cover call. Matter of fact, most stocks are garbage. Matter of fact, 97% of stocks I don't want you to buy. I want you to buy the top 3%. Write that down.
Doing it already.
Invest in only the top 3% of stocks. Actually, I'm gonna put in brackets 1%, but I'm not strict. You're gonna have to be your own shrewd stock selector, and that's gonna reflect on how much money you make. So I don't want you to buy crap. No penny stocks, absolutely not. No stocks that are, low price. New stocks that haven't proven themselves. Okay, we want to go with the tried and true. Right, that tried and true. And true. Because if you're given $1 million to invest, and this is somebody's life savings, you can't just buy crap. You can't just throw darts at the board. You want to buy the sure thing. I'm going to show you how to make safe trades. A lot of that is stock selection. So today we're going to talk about stock selection. Okay. Stock selection.
Question.
Yes.
One of the don'ts you said, don't buy stocks that are too low of a price. Is there like a cutoff point, or roughly what's too low?
Well, there's no cut price per se, but here's the thing: the reason you have high price stocks is because they've proven themselves by going up in price. So don't invest in low price stocks in a general sense. I would say $100 is a nice marker, but like Philip Morris is 93, and they had a stock split. I mean, when you have a stock split, you divide your price in half. So if you consider the stock splits they've had, the price is like several $1,000s. So in a general sense, we like stocks between $100 and like $300. However, if it has stock splits, it could be lower.
Right.
Make sense?
Yes.
So I'm going to put here price 100 to 300 per share plus, but then in brackets, consider stock splits.
How long would you say after a split before it goes back to their pre-split dollars? Months, years?
Oftentimes, it goes back up to price, right?
Mm-hmm. Yes.
Oftentimes, the price splits on these stocks we're investing in, and the price goes back up to the original pre-split price within a year or two.
Okay, great.
Let's say 1 to 3 years after stock split, stock moves back up to pre-split price. What does that mean?
Want some eggs?
Yeah, thank you. Want some eggs?
Sure.
Pre-split price. So what does that mean? That means that if you have a $20 stock that's listed to 100, 2 for 1, then you're going to split from 200 shares, $200 a share to $100 a share, and then you're going to get double the shares. So on the first day, the value doesn't increase, but because that stock split down in price, the investors come running to a more what appears to be favorable price, lower price, and then that stock price gets driven right back up to the pre-split price. Does that make sense?
Yeah, I got it.
Okay, now I forgot. I want to answer all your questions. Before I get into this, what's your top question, your top 2 questions you have for me today? Let me do that first. Then we jump into this. Anything that's bugging you?
Yeah. Before I do my first covered call, how much should I have available approximately, money-wise?
Okay, so I use Tesla because it's like a good goal to cover call that stock. But since you're coming into the market, new, and I know you don't have a huge account, we're going to look at stocks like AMD, which is 140. I think it was 144 today, which is 14,400. 114.4K. Smaller stocks like we can do Skechers, SKX. Let me. Have you heard of Skechers, SKX?
Is it like the shoe brand Sketcher?
Yes.
Yeah.
Let me give you the price on that. Where's my Skechers? It's good to have a list of stocks you can take a look at every day, but I don't want you to watch too many because it gets kind of monotonous. Okay, SKX is 43.40. Okay. Down 18 cents. It was kind of a quiet day today in the market. Last day of trading.
Right.
AMD was, I'm gonna get the right price for you. 143.90. The 144 is fine. And then I'm gonna tell you, I personally don't like Twitter. Okay. The thing is, I made a lot of money on Twitter, and I've been on Twitter for like over 10 years doing cover calls. Twitter is 43.22. Down 124 today. But I'm gonna cover AMD Skechers and Twitter for you.
Okay.
Because they're good cover call stocks. But when I said I don't like Twitter, I mean that I want Twitter to be the worst investment you invest in, meaning that all the stocks aside from Twitter need to be caliber stocks. Okay. I personally, don't like Twitter because I think Dorsey's a dipshit, and I think the way he runs his company, is like whatever. But Twitter pays a great cover call return. Okay. And it tends to the price tends to maintain. Okay. So it's a cover call stock. So when you pulled up Tesla last week, did you learn how to pull up all the options?
Yeah.
You did. So there was an 1120.
What?
There was an 1120 stop strike price.
Oh, okay.
Oh, you didn't pull it up? You didn't find out how to do all the options?
After we hung up, I didn't look at
I want you to listen. I want you to call your broker and have him walk through your app with you and ask them how to pull up the higher options on Tesla.
Oh, I did figure it out. Yes.
Okay, good. So you know how to select all strikes.
Yes.
Okay, great. So let's do this. Let's pull up AMD, which takes 14,000, Skechers, which takes 4,300, and Twitter, which takes the same 4,300. And I want to pull up, like I said, we're writing the monthly strikes. We're not doing weeklies, okay? which is the third Friday of every month. But because we want to get a price for 30 days, we're going to do the weekly today, because this is the end of the month. You go to January 28th, and then we're going to get the price for that. Okay.
Mhm.
Okay. So now we're going to do. So
You
right
want
now,
me to look it up
AMD
now?
144. The AMD we're going to do is 150. The sketches we're going to do is 45. SKX 45. And Twitter we're going to do is 45. This is going to answer your question, okay?
Okay.
So now we're going to do January 28th. Is it 28th? Whatever day that is, the last one of the month, 2022, which is 30 days, okay?
Okay.
27 days, close enough. Now we're going to look at the strike, 150 for AMD. Let's do that first. AMD January 150, what is it?
Hey, Eric, are you wanting me to follow you on this? Where you
Yes, yes,
okay,
yes.
you go
I need you
look.
to pull up
Right.
January 28th,
Hold on,
150 strike for AMD.
okay, I'm not even there yet. Sorry.
While you do that, I'm gonna pause and grab my headphones.
Okay. Look for.
Okay, so we're looking at AMD January 28th, which is the last option chain of the month.
Mhm.
And we're looking at strike 150 calls.
Okay. Again, I'm trying to. I'm limited. I'm only goes up to 148. I don't know how I did it last time. Let's see.
Okay, yeah. So you have to open up all the options here. What you're looking at is like, see, this is what I'm talking about. The way they train people. They don't tell them everything. They don't want to tell you everything, because then you might get rich like them. They want to keep this knowledge to themselves. So they make all these apps. You can't use them, right?
Mhm.
So we're looking at the one. You said one. Is there 148?
148, yeah. But
Well, hey, you know what? Hang on.
one day I was able to
We're gonna give ourselves a raise. We're gonna do the 148. Okay.
instead of
Why not?
150.
No. What you 148? Give me the 148. They didn't ask.
That's not upside time on board.
148. Okay. 148. Get quote. Sell to open. Sell to close. Open interest. Volume. Get quote.
Just a bid. Just
Okay.
a bid. I don't need any of that information. I don't need you to click on it. I need you to just look at the first layer of information.
Last change percent. Oh, it is 6.8. Is bid.
6.8.
Mhm.
Perfect. Wonderful. You did it. Now, what you do now, what they're telling you, you have 100 shares of AMD. Write the cover call of January 28th. You press -1, put this -1 CC. What does CC mean?
Cover call.
For that strike and that price, which is in this case 148, they're going to pay you $6.8 per share, which is $680, Ivan.
Mhm.
Okay, and that's going to be monthly. Now, we want to do the call options on time, which means we want to write the third week. In this case, the 21st. But we're already late, so we're going to write the later week so we can get a full month. Does that make sense?
Yes.
So watch this. Clear your mind.
Okay.
Listen to me now. Watch this. 6.8 divided by your share price, which is you have to pay 144, equals 4.72% return. How does that sound?
6.8 divided by 144 equals 4.72. 4.7.
So we're getting the return based on the premium they show, based on the stock price we pay. So we bought the shares at 144 today, and with the cover call, you would get for $680, 4.72% return. Now, we do it every month. I'm going to put times 10 because sometimes we'll do it for 2 months, or we'll take a break, or we'll miss our time. So I want it to be doable for you. So I'm going to say just do 10 times a year.
Okay.
So we're at 47.2% But you probably won't get that because, like I said, the stock's going to swing up. You'll have to buy it back higher. Stock's going to dip down. We lose share growth. So let's just say 35% return for the year. Okay.
Mhm.
I'm trying to make it doable for you. You can mess up and still do it right. Okay. All right. Any questions on that?
Nope.
Now we're going to do Skechers. SKX. Pull up SKX and give me the 45. And then we're going to do Twitter and give me the 45. Same scenario. January 28th.
So let me look up Skechers, SKX.
Yes.
Skechers,
You're
okay.
doing good.
January 28th. And a strike price of, it only goes up to 48 for me because I forgot how
We're doing 45.
oh, we're doing 45 and selling for 43 right now.
Yeah.
Okay, so minimal increase. Right? Okay, 45. Oh,
Exactly.
so at 45,
It should show you the price right there on the band that shows you the stripes. It should show you the price right there. You don't have to click on it.
yeah, I just have to like slide it over. It's
You can slide it over. That's fine.
where's the bid? Oh, here it is. At 45, it's at 0.8.
0.8.
Mhm.
So 80 cents. Not great. Not great.
This is size 33. Does it matter?
Don't look at that.
Okay.
I don't want to confuse you. I want you just to look at the raw numbers. Now, is there a 44 or 43.50?
There's a 44.
Do the 44 because I don't like to get 80 cents, which is $80. I like to get over $100.
44 is 1.2.
That's a little better. So we're going to do right to 44, which means we agreed to sell the stock at 44, Ivan. All it means is we're going to come in with 100 shares at 43.40. We agree to sell it at 44. And what that means is if we buy at 43.40 and we sell at 44, we get 60 cents share growth.
Mhm.
So put 0.60 SG, which is share growth. Now, like I said, the share growth is never guaranteed. So I don't count it, but it's there if the stock goes up. The stock goes down, we'll start losing money on the stock. Meanwhile, we're getting how much is 1.2?
Yeah, 44 is 1.2.
1.2. We're getting $1.20 on each share for a cover call. So now we're going to do our return 1.2 divided by 43.4. And I'm going to do that right now. We're going to get 1.2 divided by 43.4. Our return is going to be 2.76%. 2.76%. Now, I think that's still a great return. You're looking at over 20% for the year. But obviously, that return isn't what we're getting in AMD. It's surely not what we're getting in Tesla. But you have to consider, we're only putting 4,000 up. It's not like a big investment. The Skechers is not as quote unquote favored as AMD and Advanced Micro Devices, or as favored as Tesla. So the returns are going to be less. Now, I will tell you that Skechers being a product company, like you said, tennis shoes, clothing, it's not going to be as volatile as these technology stocks like Tesla and AMD. So that is an advantage in the sense that your account's not going to go on a wild roller coaster ride. When the market's down, Tesla might be down 100 points, but Skechers might only be down a couple points. Okay, you understand?
Yes.
Okay, wonderful. So this gives 2.76% return. Circle that. I'm just going to put 20% for the year. Okay, just round down. Everything I round down because pay attention. I want to under promise and over deliver. Okay.
Mhm.
Now let's do Twitter. You ready to do Twitter?
Yeah.
We can look at probably the 45, but if there's a 44, that might be something. So let's look at both of those. What is it?
Twitter is, what's a ticker for Twitter?
Sorry, TWTR.
TWTR. Thank you.
You do stocks, don't you?
What's that? I don't have.
I said you do stocks, don't you? Twitter, TWTR.
Yes.
Write it on your wall.
Got it.
Right on your wall with a big black marker.
Okay. So January 28th again. At 43, we're gonna go. Let's see what the bid size is.
The bid size just shows who is on that trade on the next trade, but
Sure.
that doesn't matter to us.
Okay. At 45 it's 1.09.
Wonderful. 1.09. Is there a lower strike?
Yes, 44 is one.
Let's just since we're doing the 44 for Skechers, we'll do the 44 also for Twitter.
Okay.
Which is a raise.
Is that called a strike? That's called a strike price, right? 44
Before strike. Yeah.
bid on that is 1.42.
1.42. Like I told you, I mentioned that Twitter's a good cover call stock, so it's paid more than Skechers. So now I'm going to go like this. I'm going to go 1.42, which is $1.42 a share for agreeing to sell Twitter at 44 for the next month, divided by 43.22 equals 3.285% return, which is 33.33%. Kind of rounded up to 3.3 is close enough, which I'm going to say is about 25% return for the year. I just rounded up to 3.3 if you don't mind.
Yeah.
Okay. Are you following me?
Yeah, you said that was a. Let me repeat that. So Twitter, TWTR, if we're going to do a strike price of $44, they'll pay you $1.42. So you divide $1.42 from what you get paid, divide by what you pay today, 43.22, comes out to 3.3 approximately. Times it by 10 months, comes out to about 33%.
Now I want you to think about. Don't write nothing down, but think about this. You can review it in the recording. One of the things I've done with the cover calls, teaching cover calls, is coining this phrase. It's called the cash cow. What that is when you get a position where over time you've written so many cover calls that your cost basis becomes zero, and you basically can't lose money because you paid for your initial purchase over the months and months of writing cover calls, generally around within 3 years. And now all those premiums you receive, you bring your costs down to zero, basically, and then cash cow, meaning you just keep making money monthly on these cover calls, and your cost basically has been reduced to zero, so you can't really lose money.
Mm-hmm.
So like if you're getting 3.3% return, right? You need to get that to 100% return over the months, right? So every month you're getting 3.3% return. If your initial cost is 100%, you know that. The first month your cost in a way is reduced to 96.6. Okay. So if that's the case, how many months does it take to pay for your, let's say Twitter? How many cover calls will you have to write at these numbers to bring your cost to zero? You can do it percentage wise, or you can do it $1.42 by $43. Either way, how many cover calls would it be? You know how to do that math?
32 months.
32.
I just figured out in my head. I just kind of.
Let me see. 43.22 divided by 1.42. I guess 30 months, 30.43. Pretty good, pretty close. Okay, so 30 months. How many years is that?
2.5-ish.
So between 2 and 3 years, guess what?
Yeah.
Doing these calls, you could in a way reduce your cost if you can at least save that money or put that money to an important investment. In a way, your cost is zero. Okay, And now you still have the shares, and now you're just eking out profit, and you since your cost is zero, like if you put that money aside, for example, you can't really lose money now because your cost is paid and you're just getting money.
Right.
Cash cow.
Cash cow.
I don't want to blow up your brain. The point is, the idea is that I'm looking long. When I get a cover call stock, I'm looking long term. How much am I going to make in a year? And when does this position become a cash cow? Luckily, I have a cash cow on Netflix, on AMD, on Apple. Okay, it's been like that. Eventually, start going to 200 shares, 300 shares, 400 shares. Exponential returns. You just put the money to buy more. If the stock is good, you put the money to buy more and more shares. If the stock keeps paying you monthly on these cover calls, I've been on Twitter for more than 10 years, but I stopped doing all this nonsense about this political garbage. But that's just my choice. Don't let that affect. Don't let my personal opinion affect your making money. Okay, if I say so and so, I don't care for so and so. You have to look at the numbers and see if it's a good stock and see if you're comfortable with that, right?
Mm-hmm.
Okay, so in answering your question, you can come into Twitter with 4,400, 4,300, Skechers 4,300, and AMD 14,000. Is that more doable for you?
Mm-hmm. So that's what about
Is that more doable for you?
Yes, and 14,000. So we have about what is this? About 22,000. You could start.
If you did every one of them, that would be 22,000. Yeah. You don't have to do all of them. You can do one or two to get your feet wet, to get comfortable. So like, I know you have some shares coming into my course, and I just want to say in a very nice, respectful way, the hardest thing that I've had to do in my mentoring and teaching people that come to me, how do I do this? What are you doing? Explain to them how, help me do it. The hardest thing I have to do is tell them that the stocks they have are dog shit. and because
right.
They saw them on TV, they fell in love with the product, but the thing is like I said, I combed through 1,000 stocks to get to Tesla, 1,000 dividend stocks to get to WHF, Whitehorse Financial. So I really want you to just invest in the best. Even if you think they have a good idea, we don't invest in ideas. We just don't.
So I should go now. In order to get that, I would have to just go and sell those piece of shit stocks.
We don't invest in ideas. We'll take your stocks, one by one. We can't do all the criteria today, but I'm going to tell you the criteria, and then we can talk about like the first three today. So write this down. By the way, you understand that you can write these cover calls starting tomorrow, starting on Monday?
Mm-hmm.
Okay, you understand that? Okay, so let's do stock selection. Now I have 10 points. These are not in books. They're not on the TV. They're not in seminars, okay? This is my personal way that I know how to do it, that I've done it. I'm showing you how I do it. See if you can make it work for you. I'm what you call a contrarian. So they say something on TV, this is hot, probably run away.
Okay.
Because what they're doing, believe it or not, they have that stock. They're trying to pump it up to sell it to you, and then they dump it, and then the stock goes down.
Yep.
So don't fall for that. It's okay to be a contrarian. Write that down. Contrarian. That means that you don't follow the herd mentality. You have your own. It's like you think of Warren Buffett. He's always like one step ahead.
Right.
Oh look, stock market crash. He's buying. He has a shopping cart on Wall Street. And everyone's going, "Hey, my stocks are going down," and Warren Buffett's buying. So
yeah.
you want to have, in a sense, a contrarian attitude to these things. When it's really high and it's doing great, you're making profits, and when it's dipping, you're buying cheaper. That's pretty much what it is. Okay, so I have 10 stock selection. I want to make it really simple for you. Each one of these selections, I can write a whole book on it, but I'm going to just tell you the basics. Okay, first one is 10-year chart.
What is it?
10-year chart. 10-year chart. That means you
10
look at the stock chart for 10
Oh,
years.
okay.
So what does that mean? That means that the stock has to be trading for 10 years, man. You're not going to buy like some new idea somebody hatched last month, okay? Because it's not proven.
Right.
If you look at Coca-Cola, that just broke 100 years in the stock market. So they had the 10-year chart 10 times. So you think that's like a fluke? No, that's a profitable business, reputable. They serve like all the world, right? They have a real product, right? They
Can we
make real
stop recording
profits.
real quick?
Yes.
Give me
Yeah, go ahead.
1 minute. I'll be right back.
Okay, so the 10-year chart means one, there's 2 points to this. The first point, it's been trading for 10 years in the stock market. And here's the thing. Over the decades, I've seen stocks come and go, and a lot of them don't even last 10 years, Simon. So the 10-year chart is like one of the most meaningful things. It has to be traded for 10 years. And then the second thing is the chart has to go from the bottom left to the top right. Meaning it's not going down in price, it's going up over time, right? Now, the bottom left to the top right, that could be like a minor increase, but usually it's a pretty major increase. So in the last 10 years, we're looking at stocks that have increased in value. So one is that they have been trading for 10 years. And the second part is that bottom left to the top right. Do you understand?
Yes.
Bottom left, top right. The next one is volume. Why is volume important? I'm going to break this down in layman's terms. The reason why we have to have a stock that has a huge amount of volume is because a huge amount of volume tells that there's a lot of investors, traders in that stock. And when that stock dips, which it always will, all stocks will dip, the investors will come running and buy the stock at that lower price, and it's going to push the price right back up, which is going to save your ass, okay? If you have a no-name penny stock company that dips, there's nobody knows about that stock, and it might take forever for it to come back, and you're going to be holding the bag, right? You'll be left holding the bag, and we're not doing that. We don't have that luxury to wait. We have to make money monthly and yearly. So again, heavy volume means that there's enough investors that are going to push that stock price up when it corrects, okay? So the volume I like is I'm going to put between 2 and 4 million per day, okay?
Okay.
Now, again, consider share price. Is
that number 4?
No, it's number 2.
Okay.
One is 10-year chart. 2 is volume. When I said 1 and 2, I was talking about number 1. I was breaking that up into 2 parts.
Oh, so
10-year chart is part 1 of the 10-year chart. Is that like that we've been trading, and then 2 on the 10-year chart is that this chart goes from the bottom left to the top right.
Got it. Okay.
That's all number 1. Number 2 is volume. 2 to 4 million shares traded per day.
Okay.
And then put here share price. Okay, this is what CMG, Chipotle. You know Chipotle. You had their food. That's one of my core 10 stocks. And Chipotle, let's say, is 1,700. Okay. Now, it doesn't have 2 million volume, but what you got to consider is that the share price is 1,700. So if you say that Chipotle at 1,700 is 10 times the price of Apple, which is 170, then what you do, you can multiply the volume times 10. So the volume on Chipotle is 300,000 a day, 300K times 10 equals 3 million. It has 3 million volume compared to a normal stock price of 170, which is what I like, between 100 and 300. So my point, CMG at 300,000 volume a day meets the requisite for volume, because we're considering the share price is 10 times, you multiply volume times 10. Makes sense?
Yes.
You do the same thing for Amazon, but Amazon already has millions and millions of volumes, so it doesn't matter. But the point is, you do consider the share price in that case. So 1 10-year chart, 2 volume, 3 we're going to put on profits, which is Can you hear me?
Yeah, so it's the share
Which
price
is,
is part of 2. I'm sorry.
no, I said 3 is profits. We're on number 3.
Okay,
Yeah, number 2 is volume.
and share price is in the volume.
Share price is in volume.
Okay, got it.
Consider share price.
Okay.
If you have a lower price like Twitter, Twitter 2 million is not really great because, it's a lower stock price. So, I mean, Twitter has more volume. There's plenty of volume. Here, let me look. Twitter.
That's okay.
I think it has like 9 million volume. Let me see. I don't want to leave people hanging and listening to this. Twitter has market cap 34 billion, volume. Average volume is 16 million per day. So the volume on Twitter is perfectly fine. Okay. Lower price. Okay. Number 3 is profits, which means PE. Put PE, which is price earnings. Price earnings. Okay, now, the thing about PE, with number 3, is it has to have a PE, which means it has to show a positive PE, which is a positive number, not a dash or a negative. So no dashes, no negatives. No dashes, no negatives. Which means it has a PE, let's say, of 30. That's a positive PE. Has a PE of 100. That's a positive PE. Okay, now, you're gonna have people that are gonna tell you this guy is an idiot. He doesn't know what he's doing. The PE, if it's lower, that shows a higher profit return. If the PE is higher, that shows them making less profit per share. Okay, but here's the thing: I actually like higher PE stocks because they tend to pay a lot more money in the cover call. They're more favored in the market, and the stocks go up, and those stocks go up in price. I'm gonna tell you that a good PE is 28 plus. Okay, write that down, 28 plus. Now, traditionally, stocks that have between a 10 and 20 PE are fairly valued. This is really nonsense. The PEs that are 30, 40, 50 are overpriced. Okay, but here's the thing: I've been on Netflix for more than 10 years, and I bet on a cash cow. It makes great return. And people tell me, oh, your Netflix is overvalued. The value of Netflix is $34 a share. Great, well, tell that to my mortgage is paid off, to my car is paid off. Right? So it's okay to have high PE, especially if it meets all these criteria. Okay? You don't have to go over that in the recording. Okay? So we got 10-year chart, volume, and PE. Again, the PE can't have a dash or a negative. Okay, now I'm just going to give you 2 more, but I'm not going to go into them. I'm going to give you just what they are. For 4, I'm going to put, since we're doing cover calls, I'm going to put cover calls. Cover calls should pay between 2 and 5% return per month. Write that down. Cover calls should pay between 2 and 5% return per month. And number 5, let's say dividends. If a stock pays a dividend, that's good. And that shows something. That means something. If they can pay a dividend, then the stock price can survive, right? So dividend is a requirement. Now, most stocks don't pay dividend, but if you can get a dividend, that's better. So like if we do have 10 criteria, we might have like 6 or 7, which is good, or 8. You won't get all 10. It's very rare you'll get 10, but if you can get 7 or 8, you're doing great, and that's a good stock for stock selection. Follow me?
Yes.
I'm not gonna do all 10. Let me just do one more because I don't want to leave you hanging. 6 is stock splits. Now, why stock splits? Like, here's another thing. Like, what is this guy talking about stock splits? It's an accounting trick. People tell me, oh, stock splits is just an accounting trick. You don't make any money on stock splits. No. A stock split happens because the stock is doing so great over time, the price has gone up and up and up and up and up, that the CEO and the board of directors sit down and say, listen, we're going to cut our stock price back, double the shares on a 2-for-1, or triple the shares on a 3-for-1. And what happens is that brings the investors running to what they perceive to be a better price, lower price, that increases the volume, which is great. and then increases the investor pool, which is great. And then guess what? Like we said, over time, between a year and 3 years, it's going to bring that price back to what it was before. And now you have a stock that's doing great, that's making you great money, that has great money on the cover calls. And that's why stock splits are important. So the stock has to have stock splits. Okay. Let's just say at least one, but 1 to 3 stock splits. Put 1 to 3 stock splits in parentheses. Now, if you look at my core 10, Nike, Starbucks, these stocks have had a lot of like 6 or 8 stock splits already. So if you break down that stock split back to what it initially was, like if you have a 2-for-1, the stock goes to 100, you have a 2-for-1, it goes to 50, and you double your shares, right? But if you look at the stock splits, let's say Starbucks had or Nike had, the initial price of that company without the stock splits would be like $5,000 a share. Now, I don't know how many shares I could buy for $5,000 a share, but I'm glad they split because now I can afford to buy more shares and buy more cover calls. So when you hear someone say stock splits are only an accounting trick, that it's not an accounting trick, okay? Just ignore those people, okay? However, you're looking for forward stock splits. So put forward stock splits, 2-for-1, 3-for-1. Apple had a 4-for-1 last year. Tesla had a 5-for-1. Netflix had a 7-for-1. So these are like tremendous things happening in the market, and this is what's going to make you rich and what's going to make your core 10 excellent stocks. Not the dog shit that most people come to me with, but these are real points of value to select your stock with. We're going to do 7 to 10 next week or next year.
Okay.
Sound good?
Sounds good.
Thank you, Ivan. Write some good notes and send me your homework.
Will do. Thank you.